Today, the S&P/TSX Composite Index closed at 35,568, a new all-time record high. The S&P/TSX Composite Index rose 0.6% to a record close of 35,568 on Monday, as oil prices tumbled following a pause in hostilities between the U.S. and Iran. That is up 29.79% from 1 year ago, one of the strongest 12-month runs in the TSX's recent history. If you have money in a Canadian equity ETF, your TFSA, or your RRSP, your portfolio is likely at or near an all-time high right now, too. So the question every Canadian investor is asking today is the same one. Should I be doing something about this? Selling to lock in gains? Buying more before it goes higher? Doing nothing and hoping it continues? The fact that this question feels urgent right now, at a market record, is itself important information about investor psychology. And the answer, as always, depends on something more specific than the number on the screen. This video covers exactly what drove today's record, what the connection between an Iranian ceasefire and your TFSA actually is, what this week's major events mean for Canadian markets, and what Canadian investors should and should not be doing right now. Today's TSX record was not driven by Canadian economic data, a Bank of Canada decision, or a corporate earnings surprise. It was driven by a ceasefire pause 10,000 kilometers away, and understanding why connects a Middle East diplomatic development directly to the number in your brokerage account. The chain of events. The U.S. paused its attacks against Iran, while Tehran said it had halted its retaliatory military strikes in response and engaged in talks with Oman regarding the Strait of Hormuz. This matters because the Strait of Hormuz is the choke point through which approximately 20% of the world's oil supply passes. When U.S.-Iran fighting escalated in July, oil prices surged more than 20% in July as fighting escalated, on fears of supply disruptions to the strait. Higher oil prices mean higher energy costs for businesses and consumers, which means higher inflation, which means central banks like the BOC and the Fed stay restrictive for longer, which means higher interest rates, which means lower stock valuations. Now run it in reverse with a ceasefire. Ceasefire, pause to oil supply, fears ease. Brent crude fell 8.7% to $88.36, and WTI fell 7.5% to $82.61 today. Lower oil leads to lower energy inflation fears. Lower inflation fears leads to bond yields fall. Canada 30-year yield fell over 1% today. Lower bond yields, financial stocks rally, CIBC plus 0.8%, Brookfield plus 1.1%. Lower bond yields leads to gold more attractive. Agnico Eagle, Barrick, WPM, each up approximately 1%. Lower inflation fears leads to tech valuations expand. Shopify plus 5%. TSX hits record. The energy sector was the only major loser. Energy shares declined on lower oil prices, with Suncor and Cenovus losing nearly 3%. Lower oil is bad for Canadian energy producers' revenues, but good for almost everything else in the economy and the market. The fragility caveat: this has happened before. This exact dynamic played out in reverse on July 8th. Stock markets fell after U.S. President Trump said the ceasefire with Iran was over, sending oil prices higher. The S&P/TSX fell 336.79 points that day. The ceasefire-driven rally is real. It is also fragile. Trump's statements on the Iran situation have been volatile, and a single tweet or announcement can reverse today's entire move within hours. Here is the vault. The specific reason a market record is both genuinely good news and a warning signal at the same time. The good news: records are normal at healthy markets. The S&P 500 has hit approximately 1,100 all-time record closing highs since 1950. That is roughly 15 record highs per year on average. Markets that are functioning correctly trend upward over time because the underlying companies are growing earnings, paying dividends, and becoming more valuable. A record high is not an anomaly. It is the expected long-run direction of a healthy equity market. Investors who sold their holdings at previous TSX records, at 30,000, at 32,000, at 33,000, at 34,000, and waited for a pullback to buy back in, missed the subsequent gains every time. The TSX at 35,568 today felt expensive at every record on the way up. The warning signal for one specific investor behavior. A record high is a warning signal specifically for leveraged investors and short-term speculators, not for long-term index investors. Here is why. When markets hit records, a predictable psychological response activates FOMO. The fear of missing out drives investors who have been sitting on the sidelines to rush into the market at elevated prices, often taking on more risk than they normally would, using margin, concentrating in the sectors or stocks that have run hardest, or moving emergency fund money into equities. This is the specific behavior that records warn against. The investor who buys XEQT on a regular monthly schedule, regardless of whether the TSX is at 30,000 or 35,568, does not need to do anything different today. Their next contribution will buy slightly fewer units at today's elevated price than it would have bought 6 months ago. That is fine. The long-run return of the index does not depend on entry point to the degree most people believe. The CAPE context, as covered in the market valuation video. The Shiller CAPE ratio for the S&P 500 stands at approximately 41.4 as of July 2026. This is historically elevated. Combined with the TSX's strong 12-month run, the honest expectation for forward 10-year returns from current levels is lower than the historical average. The record does not mean the market is about to crash. It means the expected return from here is probably 4% to 7% annually rather than 10%. Plan accordingly. Today's TSX record happened on the first trading day of what is one of the most consequential weeks in markets this year. Here is what is coming and why it matters. Event 1, Big Tech Earnings, Amazon, Apple, Meta, Microsoft, Tuesday to Thursday. A succession of quarterly reports from Amazon, Apple, Meta Platforms, and Microsoft will either soothe investor fears of rampant artificial intelligence spending or add to them after Alphabet's disappointing results last week. The results could directly affect semiconductor companies that are the chief beneficiaries of the AI spending spree. Alphabet's results, already released, disappointed on AI spending concerns. Specifically, investors are watching whether the enormous capital expenditure on AI infrastructure is generating proportional revenue growth. If it is, markets will be relieved and tech will rally further. If it is not, the AI bubble narrative gains traction and tech sells off. For Canadian investors, Shopify's plus 5% today tracks U.S. tech sentiment directly. A tech sell-off in the U.S. would hit Shopify and the TSX's technology component. Event 2, U.S. Federal Reserve interest rate decision. Wednesday. The Fed is expected to hold rates steady at its Wednesday decision, but the press conference and forward guidance matter enormously. If the Fed signals concern about persistent inflation, potentially driven by Middle East energy costs, bond yields rise and equity valuations compress. If the Fed signals a September cut is likely, markets rally further. This directly affects Canadian markets through bond yield contagion and risk appetite. Event 3. The Iran ceasefire stability. Today's rally was built on a ceasefire pause. Despite Monday's decline, oil remains up more than 20% this month, as supply disruptions expanded from the Strait of Hormuz to the Red Sea. The underlying tensions have not been resolved. A return to hostilities, which has already happened once this month, would reverse the oil price move, push inflation fears back up, and hit Canadian financials and tech. Watch Trump's statements on Iran very carefully this week. Event 4. TSX earnings, Celestica and Gibson Energy after close today. Celestica and Gibson Energy are scheduled to report earnings after the market close today. Celestica is a Canadian technology and manufacturing company with significant AI infrastructure exposure. Its results will give Canadian-specific insight into the AI spending theme. Today is a good day for Canadian investors' portfolios. It is also a day when the specific temptations around market records, the urge to act, to buy more, to lock in, to panic, are at their highest. Here is the specific framework. If you are a long-term index investor, XEQT, VEQT, VFV in a TFSA or RRSP, do nothing different. Your monthly contribution goes in as scheduled. Your DRIP reinvests dividends as scheduled. The record high does not change your plan. If your plan was correct last month, it is correct today. The only action worth considering: if you have significant unused TFSA room and cash sitting in a savings account, the long-term case for deploying it remains unchanged regardless of today's level. If you are a dividend investor holding Canadian banks, pipelines, utilities, today was a good day for financials. Your banks went up. Celebrate appropriately. Then look at your dividend yield relative to cost and make sure your portfolio's income thesis is intact. Do not let a good day tempt you into overconcentration in what worked today. The rotation away from energy into financials today is a single-day move driven by a single event, not a structural signal to shift your entire portfolio. What not to do today: do not buy more because you fear missing further gains. FOMO investing at records has poor historical outcomes. Do not sell to lock in your gains. Locking in gains is locking out future compounding. Do not add leverage. The ceasefire that drove today's rally has already reversed once this month. Do not move emergency fund money into equities because the market is up. Do not make dramatic portfolio changes based on one day's news. The honest week ahead. This week contains 3 potential major catalysts: big tech earnings, the Fed decision, and Iran news. Any of them can move the TSX significantly in either direction. A Canadian investor whose plan is robust to all 3 outcomes, including a 2% to 4% pullback if Iran escalates again or tech earnings disappoint, is in the right position. A Canadian investor whose plan only works if the rally continues needs to reassess the plan, not the market. Let's come back to where we started. TSX 35,568, all-time record, up 29.79% year over year. Oil tumbled after the U.S. and Iran paused strikes. Bond yields fell. Financials and gold miners rallied. Shopify jumped 5%. This is good news, genuinely. If you have money in the Canadian market, in a TFSA, an RRSP, a pension, today was a good day. The 12-month TSX run of almost 30% is exceptional and reflects a combination of BOC rate cuts, the global commodity rally, and multiple risk-on episodes like today. It is also fragile. The same ceasefire that drove today's record drove a 336-point TSX drop on July 8th when Trump declared it over. Big tech earnings this week and the Fed decision Wednesday are both genuine market-moving events. The CAPE is still at 41.4. Expected forward returns from here are lower than the historical average. The right response to a record high is the same as the right response to a market low. Follow the plan. Contribute on schedule. Stay diversified. Don't leverage. Don't FOMO. Let the compounding do what compounding does. The TSX hit 35,568 today. It will hit 40,000 eventually, and then 50,000. The investors who will be there when it does are the ones who stayed invested through every record high and every pullback in between.